Welcome back everyone to session 3 of our risk management course. If you've been with us in the previous sessions, you now have a strong grasp of the fundamentals and advanced techniques of managing risk. But today we are taking it even further. We're diving into the power of data in predicting and controlling risk. So in trading, a risk isn't just something you react to, it's something you anticipate. And I would say the best traders in the world don't just manage risk, they predict it, quantify it, and adapt their strategies accordingly. So in this session, we'll explore how real market data, volatility models, and statistical indicators can help us make smarter decisions and reduce unnecessary exposures. This webinar is brought to you by Errante, which is an online broker committed to providing top-tier services and building lasting and trusting relationships with clients and partners. However, before we begin, it's important to acknowledge the risks involved in trading financial markets because trading CFDs, Forex, and other leverage products carries a high level of risk and may not be suitable for all investors. This webinar is for educational purposes only and does not constitute financial advice. We encourage all traders to conduct their own research, apply proper risk management techniques, and seek independent financial advice if necessary. So past performance is not indicative of future results, and market conditions can change rapidly. Make sure to trade responsibly. Okay, without any further ado, let's talk about something that is often overlooked: trading data and risk management. Many traders think risk management is only about setting a stop loss or managing trade size, but the reality is deeper than that. If you don't measure and track your strategy's performance, so you're making decisions based on emotions rather than data, and that can be dangerous. Here you see we have a three, let's say, steps that can answer the question, why are trading data important in risk management? First of all, most traders don't know how much risk their strategy carries. Ask yourself, how much does your strategy risk per trade? Or what's your average drawdown? And if you can't answer these questions with numbers, you're not managing risk effectively. So risk is not just about avoiding large losses, it's about knowing the probability of different outcomes in your trades. Without data, you are trading blind. And the point two is that many traders evaluate their strategy based on emotions or a few recent trades. Have you ever had a winning streak and felt invincible, thinking your strategy was perfect? Or have you had a few consecutive losses and suddenly questioned everything? This is a common trap. We tend to judge our strategy success based on the last few trades, but that's not how probabilities work. Every strategy is winning and losing streaks, that's for sure. The key is looking at long-term data, not just a handful of trades. And point three is that most traders abandon their strategy after a few consecutive losses. After 3 or 4 losing trades, many traders start changing everything, tweaking indicators, switching time frames, or even looking for a completely new strategy. But here is a problem: most traders never test whether their strategy was actually profitable in the long run. So if you change strategies too often, or you never allow a system to play out its probabilities, this is where keeping records and analyzing historical performance becomes essential. What would be the solution to these problems? Data-driven risk management. I would say the best traders in the world track their trades meticulously. So they analyze their average risk per trade, their drawdowns, their win rates, and their expectancy. They don't panic or feel losing trades because they understand the bigger picture. Now, let's talk about the three main sources of data that help us analyze risk in trading. When we talk about data, what we really mean. First of all, let's take the question, why is this important? Many traders make decisions based on gut feelings or recent trades without considering how their strategy is performing over a larger data set. So if you don't have a structured way to assess risk, you're essentially flying blind into markets. So we need a systematic approach, and this slide introduces the three key sources of trading data that help us with that. First, you see here on my screen already, which is a past trading data. The first and most obvious data source is past trading performance. Every successful trader tracks their win rate, risk to reward ratio, and drawdown levels that we talked about in our previous sessions in this course. And it should be over a large sample of trades. Why? Because without this data, you have no idea whether your strategy is working or not. So if you don't analyze your past trades, you could be making the same mistakes over and over without realizing it. A professional trader treats past trade data like a business report. You need to know if your trading model is profitable in the long run, not just for a few trades. And the second source is market volatility with ATR and price swings that we explained thoroughly in our previous session. So I really recommend you, if you have not seen that yet, please have a pause here and just search it in our social media. So you will be able to understand how and why ATR and price swings are really important and how they can be related to our stop losses and risk mitigation system. The second key data source here, by the way, is market volatility, which is crucial for setting a stop losses, as we explained there, adjusting trade size and defining realistic take profit targets. We use the average through range, or ATR, to measure volatility in Forex. And ATR tells us how much a currency pair typically moves within a given period. If ATR is high, it means the market is highly volatile and we need wider stop losses and potentially a larger risk to reward ratio. And if ATR is low, so the market is calm, the tighter stop losses with lower RRR may be more effective. And this ensures that our risk management is dynamic rather than a fixed one-size-fits-all approach. And third source is correlation between currency pairs. The first source of data is currency pair correlation, and many traders make the mistake of trading multiple pairs without realizing they're highly correlated and in which way they are correlated. For example, if you're long on both Euro USD and GBP USD and they are highly correlated, you are doubling your exposure to USD movements instead of mitigating your risk. So if both trades go against you at the same time, your risk is multiplied rather than diversified. On the other hand, if you strategically mix correlated and uncorrelated trades, you can reduce overall portfolio risk. So to manage risk effectively, we need to rely on data, not emotions. And these three sources, past performance, market volatility, and correlation, help us adjusting our strategy, set proper risk levels, and avoid unnecessary exposures. But here is a question for you. Have you ever entered multiple trades at the same time only to realize that they all are lost together because they were highly correlated? If so, understanding correlation is the missing piece in your risk management strategy. And feel free to comment under this video about your personal experience on this. One of the most critical mistakes traders make is ignoring their past trading data. So They make decisions based on emotions or few recent trades instead of analyzing the big picture as we discussed. And here we want to walk you through a structured way to analyze our trading performance, risk exposure, and potential weaknesses. There are a couple of steps we need to take. The first step is in evaluating risk is to collect past trade data. So this can be done using platforms like MetaTrader. You can use your trading journal, or you can just go to your trading history, or you can even create an Excel file for that and save all of your trading activities in an Excel in an Excel sheet. So these tools allow you to track entry and exit points first. Then the trade sizes, stop losses, and take profits, essential elements for risk assessment. And many traders fail to document their trades, making it impossible to see patterns and improve. If you don't track your results, you can't know what's working and what's not. And that takes us to the second step, which is analyzing win rate and risk to reward ratio. We call it RRR. Once you have the data, the next step is to analyze two key metrics: win rate, the percentage of trades that are profitable, and risk to reward ratio, or RRR, the ratio of your potential profit compared to your potential loss. Let me put it this way. A profitable strategy doesn't necessarily need a high win rate. A strategy with a 40% win rate can still be highly profitable if the RRR is favorable, or vice versa. And so that's why knowing these numbers is really essential to have or to design or develop a very effective risk management strategy. And the step three is evaluating maximum drawdown. We will talk about the drawdown. Maximum drawdown measures the largest peak to trough drop in capital, in a very simple word. Why is this important? Because a trader can have a profitable strategy, but still face large drawdowns, causing them to abandon the good system too soon. So if your drawdown is too high, for example, over 30% of your let's say drop from your peaks, you need to reduce position size to avoid excessive losses. A low drawdown means better capital preservation and less psychological pressure while trading. So it's really important to be aware of this number as well. And then we have to examine market volatility and correlations. Risk isn't just about stop losses and position sizing, it's also about volatility and correlation. So if your trading strategy performs well in calm markets but struggles in high volatility, you need to adjust your stop loss and take profit based on ATR, for example. But if you are trading multiple pairs, understanding correlation helps avoid taking multiple positions that increase overall risk instead of diversifying it. So let's put this into practice with a real example here. Let's say you have 100 trades with a 55% win rate and 45% loss rate. The average profit per winning trade is $120, and the average loss per losing trade is $80. So this means your system is profitable over time. But if drawdown exceeds 30% or more, it's a red flag. You need to reduce position sizes to control risk. As a final takeaways here, you should be aware that trading is a data-driven process, not a guessing game. And a profitable system is not just about winning trades, it's about managing losses effectively. So controlling drawdowns and using data-driven risk management keeps you in the game for the long run. And that's what we are going to discuss in this session. Many traders focus only on short-term results. If they win a few trades in a row, they think they have a great strategy. If they lose, they believe their strategy is flawed. But professional traders think differently. They measure long-term profitability using the key metric called expectancy. And here we are going to answer this very critical question. How can we determine if a trading strategy is consistently profitable over time? To answer this, we need to understand two things. First, how much we make when we win versus how much we lose when we lose. And the second thing we need to know is the probability of winning versus losing trades. This leads us to the concept of expectancy. So now that we have introduced the concept of expectancy, let's break it down step by step. Expectancy is a mathematical formula that tells us how much we can expect to win or lose per trade on average. So you see the equation here takes into account four key variables. First, win percentage. How often your trades are successful. Then average win, the average profit per winning trade. Then loss percentage, how often your trades lose. And average loss, the average loss per losing trade. Now, why is this formula important? Because it tells us whether our strategy, our trading strategy is actually profitable over time. If your expectancy is positive, yeah, yes, if your expectancy is positive, that means your strategy makes money in the long run. And if your expectancy is negative, that means you will lose money over time, even if you have some winning trades, very big winning trades. So if your expectancy is zero, that means your strategy breaks even, meaning you're just covering costs without real profits. So what's the key insight here? Yes, many traders focus only on win percentage and assume that if they win more than 50% of their trades, they will be profitable. You might have heard about this, some traders bragging on their winning rates. They said, oh my God, I have a strategy which is right 90% of the time and I'm making a lot of money. But after a long term, seeing this guy, you will see they couldn't make it and they're still at the point that they were before, but that's not true. A trader with a 40% win rate can still be profitable if their average win is much larger than the average loss. So you see, this is an equation. You need to balance all the participants, all the factors participating in this equation. So how do we calculate expectancy in real world trading? Let's explore that in our next slide. Okay, here we are going to take everything we've learned about expectancy and apply with a real numerical example. Let's consider first scenario. Okay, in the first scenario, we have a trading strategy with 100 trades, 40% win rate, and an average profit of $150 per winning trade. This is something. Meanwhile, losing trades, occur 60% of the time, and each losing to an average of $100 loss. So this is the dark side of our trading strategy. And when we plug these values into our formula, we see that the total expected profit and total expected loss cancel out, leaving us with an expectancy of 0. Interesting, yes? So this means that over time, this strategy will only break even, and we are not going to make money using this trading strategy. Many traders let's say, fall into the trap of thinking that if they have a 40% win rate, they can never be profitable. But that's not true. Let's see how we can adjust our strategy to turn it into a profitable one. That takes us to the scenario 2. Okay, now in the second scenario, we make a small but significant improvement. We increase our average profit per winning trade from $150 to $200. Now, when we calculate expectancy again, you guess, we find that the new value is positive, or let's say $20 per trade on average, which means this strategy is now profitable over the long run. So if you use this strategy with this higher winning rate, average win, it means we're going to be able to make money over time. And this is why risk reward management is so important. Instead of trying to force a higher win rate, traders can adjust the reward to risk ratio and make their strategy profitable even with fewer winning trades. Now, let's discuss some practical ways you can improve the expectancy of your trading strategy. Let's summarize the 3 possible outcomes. First, you see in this table, if expectancy is greater than 0, it means that the strategy will be profitable in the long run. And if expectancy is equal to 0, that over time your gains and losses will cancel each other out, leading to a break-even result. And if expectancy is negative, the strategy is losing money over time and needs improvement. Now, how can we improve expectancy? We have 3 primary ways. First, we can increase our win rate by improving entry timing, using better confirmations, and filtering out low probability trades. Second, we can improve our risk to reward ratio, RRR, by setting targets further away relative to our stop loss. This means risking less for potentially greater profits. And the third way is that we can reduce average losses by setting more strategic stop loss levels, avoiding unnecessary stop outs due to market noise. Let's take a real example. Suppose your strategy wins 40% of the time and loses 60%. If you currently have an RRR of 1 to 1.5, your strategy may not be even profitable. But if you increase the RRR to 1 to 0.5, you can turn this strategy into a winning one over the long term. But what does it mean? It means you need to reconsider your trading strategy. For example, if you were a range trader, you might consider being a trend trader. If you were trading in a scalping style, you might change to swing trading. And these are the ways that you need to reconsider in your trading strategy to increase your RRR. Because if you just out of nowhere increase your RRR, for example, put your TP in 2.5 from let's say from your entry compared to your stop loss distance, it doesn't mean that you are going to make that profit. It all depends on your trading strategy. But one thing you can understand from your trading strategy or current trading strategy is that, okay, it is not profitable. And one of my ways is to improve my RRR. Is it possible with this trading strategy, or I really need to come up with other trading strategies, or I need to change my style, I need to change my time frame, I need to change something? Okay, so it's not just about the numbers. These are all hints that can allow us to know what we are looking for when it comes to studying our trading journal. Now let's talk about one of the most critical aspects of risk management. We call it drawdown. What exactly a drawdown is? Drawdown is a percentage drop in the trader's account balance from its highest value to its lowest point before recovery. It essentially measures the worst case scenario for a strategy's capital loss. So that would be a very good number to know. Let's break it down using a simple formula here. This is the formula or the occasion or the equation that can actually lead us to our drawdown percentage. If your peak capital was $10,000 and it dropped to $7,000, your drawdown would be simply put $1,000 minus $7,000 multiplied by 100 gives you 30%. Now, why is drawdown dangerous? Drawdown is very dangerous. Our job as a trader is to decrease our drawdown, not to increase our profits, because as soon as we can come up with some ideas, with some plans to mitigate our drawdown, we will be able to become profitable trader. So this is the first step of the ladder. So we have to take it first. The deeper the drawdown, and here is why, the deeper the drawdown, the harder it is to recover. If your capital drops by 50%, you don't just need 50% profit to break even. You actually need 100% just to return to where you started. Next reason is that large drawdowns put traders under intense psychological pressure, and this leads to emotional trading, over leveraging, and impulsive decisions. Many traders panic and either quit trading too soon or take excessive risk to recover losses, often leading to even bigger failures and, God forbid, and stop outs. So what's the solution? Managing drawdowns effectively. And in the next section, we'll discuss how to control drawdowns and ensure steady capital growth. Now, let's take a closer look at one of the most dangerous aspects of trading, high drawdown. Why is high drawdown a problem? During this webinar, you can also check your trading statement. You can just extract it from the MetaTrader 4 or 5 if you are trading on any of them. Or you can just simply, let's say, gather data from your trading history and then put them in Excel and just sort it out to find out how many trades are profitable and how many are not, losing trades, and then you will be able to calculate even your averages and everything. But MetaTrader 4 is doing everything for us, and if you remember in our previous session, we discussed about it, how to extract data statement from your MetaTrader 4 and 5 trading platform. Okay, so here, if your account experiences a large drawdown, recovering from it becomes exponentially harder. Let's analyze it this table. If your account drops by 10%, you only need an 11% profit to recover. This is manageable, okay. But if your account drops by 30%, you now need a 43% profit just to return to where you started. And Of course, a 50% drawdown is even worse. You must double your money just to break even, and it might take a longer time, to get to that break-even point. So we must. What's the lesson here? The lesson here is we must prevent large drawdowns at all costs. Risking too much in a single trade or over leveraging can wipe out months or even years of gains at a snap. And if a drawdown does occur, traders must have a structured recovery plan to rebuild their capital without taking reckless risks. This is why professional traders focus on consistent risk management rather than chasing quick profits. And in the next section, we will discuss strategies to reduce drawdown and build a recovery plan. How to reduce drawdown? Now, that we understand why high drawdown is dangerous, let's discuss how to reduce and prevent it effectively. There are some steps we need to take. We collected as a method to prevent large drawdowns. The first step is to control risk per trade. Always ensure that you never risk more than 1 to 3% of your capital in a single trade. If you experience a series of losses, reduce your trade size even further to prevent deeper drawdowns, because something might not be right at that time. For example, maybe you're not emotionally balanced, or there might be something cloudy judgment you have, or maybe your analysis is totally wrong. There is something missing in the market, or maybe the market is on some let's say abnormal behavior right now because of a news announcement or something like that. And then don't try to revenge, instead just decrease your position size. And position size is a really key factor here. Many traders fail because they continue trading with the same position size even when experiencing losses. If you're in the drawdown phase, the best approach is to reduce trade size to protect your capital. So you should always take care of the percentage of your capital you have at risk per each trade. It means 1 to 3%. That's the important factor you have to get fixed. Okay, not the size of your position. You don't need to have the same to trade the same position size over different market, let's say, setups. And we explained it in our previous session. And then using a dynamic stop loss based on ATR that we talked about it in our second session, how to practically set ATR based stop loss. It helps you avoid getting stopped out too soon. Instead of setting a fixed stop loss, adjust it according to market volatility to allow room for price fluctuations. And the next step to take is avoiding the biggest mistake, over trading. Many traders, after a loss, attempt to increase trade frequency in an effort to recover losses quickly. And this often leads to more emotional decisions and even bigger losses instead of recovery. So, for example, if you trade only 20 setups per day or 1 setup per day, just stick to your plan. You don't need to rush. You don't need to change things quickly. You don't need to recover your account very fast. Of course, you are suffering from huge losses, but it's not a right way to try to revenge the market in a very emotional way. Just set a step back, look at the chart, reassess everything, and then continue what you were doing before. To survive and thrive as a trader, you must focus on risk management first. Managing drawdowns effectively ensures that you stay in the game long enough to take advantage of profitable opportunities. Now that we have covered that and ways to minimize that, let's focus on something even more crucial: how to recover from a drawdown effectively. Let's say you experienced the huge drawdown and now you need a recovery plan. How you can set it? There are a couple of steps again. It's a very brief and very short. I just hope it gives you a hint to follow. So it comes with 5 essential steps. First, stop trading and review data. This is a first phase. Pause your trading activities. Take time to analyze what went wrong. Was it poor strategy? Was it market conditions? Or you were very emotional and you had some emotional decisions? The next step, after finding the answers to these questions, next you need to reduce risk and trade size. Lower the risk per trade to protect remaining capital until you totally and fully understand what went wrong with you. And then reduce position size to avoid further damage instead of increasing your position size. This is a mistake that many new traders usually make when they got into losses. Oh, that's a suffering experience, and then they rush to recover their capital, and then trying to enter the market more aggressively and with taking bigger position. That's a very bad mistake, because in that state you are not that ready to take higher risks. So it's better to just reduce risk and your trade size. I think you have been trading in Forex. You can understand me, and I have a sense, let's say, feelings when we are in loss, when we want to recover our capital, when we are running out of time. For example, we're getting to the end of the month, we're getting to the end of the period that we set already to calculate and recalculate everything, and when we see ourselves behind the curve. And that's a very difficult situation, emotional situation to manage. But if you can control your emotions, you can control your money, and you can control your profits. The step 3 is limiting the number of trades. Do not jump back into high frequency trading, and trade more selective, only taking high probability setups until you rebuild confidence and capital. Then analyze winning and losing trades. Identify which setups worked and which ones didn't, and what was the mistake there, and how you can make it better is really important. So instead of jumping on a chart, it's better to just take a step back and start studying what you've done. Assess whether your trading strategy needs any adjustment, or maybe there are some flaws that you missed in your trading strategy. For example, you needed a couple of extra confirmations, but you missed it because you were so emotional. You thought, okay, you're 100% right, so I don't need to check these extra confirmation, and that cost you a big loss. So stick to your plan at the end of the day. And the step 5 is gradually return to normal trade size. Once you regain consistency in performance, slowly increase trade size back to normal levels. It can take time, but doesn't matter. Means eventually you need to recover yourself. And with these 5 steps, I can guarantee you will build a very successful recovery plan for your capital. And the goal is not just recovery, but sustainability. And this is you have not to forget. So a well-structured recovery plan separates professional traders from emotional traders. And please, if you want to be among the groups of professional traders, instead of reacting to losses with panic, you should act like professionals. Use data-driven decisions to rebuild effectively. Use expectancy to see if your trading strategy is good. And always, when you get to a conclusion about your trading strategy, if it needs any adjustment, just adjust it and let's say assess it with a demo account. And then when you conclude that part, when you come up confidently sure about your trading strategy, that's the time to stick to it with all means, on any price. And then that's it. You just need to have these data-driven decisions using expectancy and assess your trading strategy with the expectancy or the expected payoff. So has anyone here implemented a recovery plan after a major drawdown? I would love to hear your experiences and how you could manage to recover your capital after all. So feel free to comment or send your questions to me. Thank you. Okay, we have some questions. First, how can I improve my trading expectancy? Can you explain a bit in more details? Of course, first, you can increase your win rate if it's possible. It means focus on high probability setups and filter out lower quality trades. For example, you can set some extra rules for yourself using more confirmations or something like that to make sure that you're just going to trade the high probability setups. And then you need to improve your risk reward ratio. If it can be done with changing time frame, changing the strategy, changing your trading style, something like this. And then reduce average losses means you have to adjust your stop losses, and you have to evaluate why you for example, ended up with a huge loss in your past couple of trades you had. So in that case, you need to adapt to volatility and avoid unnecessary stop outs. So in that case, you really need to measure the volatility of the market, and the best tool to do that is an ATR. And then you have to somehow compare your stop loss distance from your entry with the ATR, which is the average volatility of the instrument, and in that time frame, so you can get an idea if you could stay more in a trade, or you just let's say got out too early or too late. And then analyze your past trades to identify patterns in your winners and losers trades to refine your approach. I hope that answers your question. Okay, let me look at the some more questions we have here. Okay, the one question I see many sent is, should I change my strategy after a few losses? People are saying we get really scared when we see we're losing one after one. So what should we do in that case? I would say no. Don't change your trading strategy unless data confirms it. A few losses don't mean your strategy is broken. So even winning strategies go through drawdowns for sure. So don't get panicked, okay? Just review your expectancy. If your expectancy remains positive, your strategy is still valid, so you can use it. And then backtest and analyze. Check if the losses are part of normal variance or if market conditions have changed. Then adjust risk management, not the strategy. Before changing strategies, reduce position sizes and evaluate execution errors to find out what was the problem with your trading setup. And then if you saw you have done everything greatly, so that's time to revise or let's say adjust your trading strategy. Okay, I hope that answers your question. And with that, we come to the end of today's session. I hope this webinar has provided you with valuable insights into risk management, expectancy, and how to structure a more robust trading plan. A big thank you to all of you for your time, engagement, and great questions. If you have any further queries, feel free to reach out through our platform or join us in our next webinar next Wednesday, where we'll continue exploring advanced trading techniques for sure. Stay consistent, manage your risk wisely, guys, and trade smart. Until next time, happy trading. See you in the next session.